Welcome to this ICMA webinar on DCM syndication practices in the Asian international markets. My name is Mushtaq Kapasi, and I'm Chief Representative for Asia-Pacific based in Hong Kong. I'm joined by two colleagues, Leland Goss, ICMA's General Counsel, and Ruari Ewing, ICMA's Head of Primary Market Practice, who are both based in London. Lee, Ruari, hello.
Good morning.
Good morning.
And good afternoon. So the purpose of this webinar is to outline standard practices in international bond market syndication, and also relate these to book building and placing in the Asian region. Just some background on ICMA. ICMA has for more than 50 years, actually, sought to promote best practices and publish market guidance in the cross-border debt primary markets. We do this chiefly through industry committees made up of representatives from our member firms, and the ICMA Primary Market Handbook, which is continually updated. In 2013, we established the ICMA Asia Bond Syndicate Forum and the ICMA Legal and Documentation Forum. So most of the topics we'll be speaking about here will have been discussed and debated quite extensively within these committees made up of our members in the market on deals. And our goal today is to give a more informal yet somewhat structured overview of these discussions, as well as the ICMA Primary Handbook itself and potential implications for market supervision. So let's begin. Lee, let me ask you a very basic threshold question to start. First of all, how is DCM different from ECM, especially in terms of initial offerings in the primary markets?
Well, one major distinction between DCM and ECM is the different investor base. DCM investors are basically lending money to companies and governments. In ECM, investors are buying a portion of the ownership in a company. These two different investing objectives result in two very different levels of risk and rewards. Equity investors as owners share in both dividends and capital gains. Generally, private profitability drives equity values. But there is also a significant downside. There is no promised economic return. One can lose everything. Conversely, in debt markets, because debt securities are promises to pay principal with interest, investors can expect repayment in full at maturity, unless, of course, the company ends up in distress or bankruptcy. Bondholders are senior to and are repaid before shareholders in bankruptcy, although often recovery is at some reduced value. So that's one difference. Another is that the new bonds and new shares are issued and distributed in the primary market differently. ECM typically includes initial public offerings or IPOs, where a company sells shares to the public for the first time. Later, after an IPO, a company may publicly offer additional new equity to the market through a rights offering. In ECM, you can also have very large block trades using accelerated book building, which technically are secondary market transactions of shares previously owned and traded, but distributed like a primary deal. Also, bear in mind, each issue of the same class of equity, for example, common stock, is fully fungible. By contrast, each new bond issue of an issuer, with few exceptions, is not fungible with past or future bond issues. In the case of DCM, none of these types of ECM transactions mentioned are typically used in the primary market for bonds. Pricing and allocation. This subject could take a long time, hours to discuss, but we'll briefly discuss the main points. There are both similarities and differences between DCM and ECM as to how new issues are priced and allocated. Both usually involve, after considering the price objectives of the issuer, taking indications of investor interest within a stated price range, building a book of demand by taking orders indicating the price and size desired by investors, fixing the final price, and then allocating and delivering the new securities to investors. A major difference between DCM and ECM here is timing. An IPO may involve months of gestation and preparation, days or weeks of physical roadshow meetings with investors, research preparation, teach-ins and distribution, corporate image advertising campaigns, and sometimes heavy media coverage. Rights offerings usually can be done more quickly, and block trades are customarily done overnight when markets are closed. New bond issues, on the other hand, can be concluded much more rapidly, often within hours or within the same business day. A related further distinction is the pricing methodology. IPO investors' focus is on the equity valuation, which in turn is based on the projected future earnings and return of the business as a whole. The greater the expected profitability, usually the higher price investors will be willing to pay. But it's not a perfect science. Mispriced IPOs happen and can be controversial or even political, for example, in a government privatization. DCM deals don't usually attract as much attention from the general media. DCM investors consider a number of factors, but a key driver is the credit and the credit rating of the borrower. Higher credit, lower risk issuers can raise capital at lower interest rate costs than lower credit borrowers who need to offer a higher yield to attract investors. In bond new issues, investors will look at both bond issuers with similar credit risk and ratings and their yield versus the relevant benchmark, usually government bonds in the same currency that are considered to be risk-free. New bond issues that offer good relative value to bonds traded with similar credit and characteristics will usually attract more investor interest and demand. I'll stop there.
Okay, thank you very much, Lee. So now that we've heard some of the high-level differences between the ECM and the DCM markets, let's focus on the bond markets. And Ruari, if you could take us through some of the background on how bond syndication works today, and also maybe a bit of the history and the reasons why the market does things the way they do at this point.
No, indeed. Thanks, Mushtaq. So, I mean, broadly, to execute a new bond issue, I mean, I suppose there are three main ways one can do it, of which syndication is but one. So for those, particularly government borrowers who have a guaranteed investor base, so either they're perhaps OECD, G7 borrowers internationally to a certain extent, for example, the US government, or otherwise for other governments, it's more in a domestic context. And since you have a guaranteed investor base for various reasons that we haven't got time to go into now, you can simply auction your bonds. You can basically, you have your primary dealers and they just go to the highest bidder. However, for other contexts, so either those government borrowers, if they're trying to issue bonds outside their normal context, and even some of the OECD or G7 borrowers, such as the UK government, they do actually occasionally syndicate bonds as well. And the reason they do that is because they are looking to develop their investor base for that in that different context. And I know it's not necessarily always the best example, but I do think of it as, particularly in the corporate context, let's say, a bit like a pop group that's up and coming and that is trying to actually broaden their fan base. So when you're preparing for a concert, you would like some tickets to go to your existing smaller fan base, but also widen it in certain ways so that gradually over time, over several concerts, you can really build up your following. And that's what syndication enables you to do. It enables you to choose who to allocate bonds to. It's an iterative process, so you can go backwards and forwards in terms of price, supply, and or price discovery aspects, in terms of asking investors, how much they would like to bid for at different prices, and then you have that control over allocation. Within syndication, however, there are also a couple of ways of doing it, and certainly there were two established historical ways. So the original way of doing syndication was what we called retention. And so what would happen is that the issuer would sell a portion of the bonds to each of the underwriters in its syndicate, and then the underwriters would effectively race to sell down their bond holdings. And now, theoretically, the initial allotment to the underwriters was based on the investor demand they felt they could sell to. And we're looking 20, 30 years ago, it wasn't always as simple as that. And some cases, the underwriters, were looking to be part of the syndicate, and the demand underlying demand might not actually have been there. And so what would happen is you'd find that there was actually a bit of a sell-off in the secondary market as residual holdings were basically dumped into the market. And of course, what you don't want as a borrower is to see that the price of your bonds is cheapening in the aftermarket. I mean, if I go back to the pop concert example, if you find, if from an investor perspective or a concert goer perspective, you arrive at the concert gate and you see that the tickets are cheaper at the concert gate than they were at the box office, it's not exactly going to encourage you to go back to the box office next time round. And so in that sense, the pot system came in from the United States. And there what happened was that all the investor orders went into a common pot, where only a handful of one or two of the banks that were actually the book runners in that transaction would actually interact with the issuer in terms of making pricing and allocation recommendations. And that way you knew exactly where the bonds were going. It therefore meant that they were, you had that focus on them going to end investors, and that risk of the bonds being dumped by members of the syndicate in the aftermarket was effectively eliminated. Now, there's still obviously today, I suppose, a residual risk that some end investors might actually flip the bonds, but it's a far, it's a much lower risk proposition from that perspective. And then lastly, in terms of ways of executing, I mentioned there were three. Of course, if you're doing smaller transactions, more targeted transactions, there are private placements, which can often be based on a reverse inquiry basis. But I think that's a slightly different focus.
Sure, Ruari. Okay, so just to clarify, so in terms of normal, maybe not normal, but prevalent practice in the international bond markets today, we mostly see now the pot system of distribution with governments, of course, meaning auction, and in some markets, we still see a retention style distribution. Is that right?
Yeah, no, absolutely. That's absolutely correct. The pot system is the standard form of execution in the international markets, and the retention system remains in a few domestic jurisdictions. And I think one needs to be very clear when one is executing a bond trade as to is one doing it on a pot basis, or is one doing it on a retention basis. And we'll talk about later possibly a bit the concept of X orders. But if you start putting too many X orders into a book, it starts looking a lot like a retention system. And so after a while, the question is, are you losing the benefits that the pot system is supposed to, has brought to the market?
Indeed, and one of those benefits of the pot system is the fact that the order book is shared. The order book is transparent to the entire syndicate with a certain aspect of, and the borrower with a certain amount of shared responsibility there. So yeah, we will get back to that point. Okay, but before we do, let's talk a little bit about the ICMA Primary Market Handbook. This is just a collection, I'd say a compendium of recommendations that are driven from the market itself. It's not ICMA that puts these together through our own heads, although we help to facilitate that. And Ruari, if you could just tell us a bit about the background of the ICMA Primary Market Handbook, why it exists, what it's trying to achieve in the market.
Yeah, absolutely. The Primary Market Handbook was originally created in the mid-80s, and it literally started off as a handful of recommendations on individual sheets, and gradually more and more elements got added, so it actually became now a proper handbook of 300, 400 odd pages. But the basic concept is about intra-syndicate transparency, timeliness, and efficiency. The idea is when a manager is a prospective underwriter is being invited to join a syndicate, it gives them an idea of effectively a default way how the transaction execution will unfold. So the banks don't have to spend hours saying, oh, and by the way, we're going to do it this way, by the way, we're going to do it that way. It's all already set out in the handbook. And unless, of course, you say, actually, no, this time we're going to do this particular bit differently, but there's only that one bit that you have to talk about. Now, it's also accessorily informational to others. So if others, it's not its main purpose, but by bringing out aspects from the handbook, it helps borrowers, investors, regulators, actually for that matter, even paying agents, clearing systems to understand certain aspects of the process, albeit that's not its main purpose. Now, what it does then is it organizes syndicate banks. It helps improve disclosure. It's in some cases from the informational perspective, and that's on the margins. It helps explain certain new practices. So, for example, when the ICE International Clearing Systems introduced the new global note concept, we brought in some standard documentation around that, which helped things. And also, the handbook, to a certain extent, picks up on the practical implementation of regulation. So, we have wording for selling restrictions which are reflective of underlying law, but we've put it into a form of drafting that then institutions can use in their transactions without having to reinvent the wheel every single time. And that carries through in that sense, obviously standardizing documents and wording more generally.
Just to add to what Roy's saying, I mean, people should be clear that the handbook does not at all duplicate or try to add regulatory requirements. It complements those. And I think the regulators are comfortable with the primary market handbook because it can, in a much more sort of granular operational way, facilitate compliance with the regulatory framework, and can be changed very, very easily and quickly when market conditions change. And there are numerous examples of that happening over the decades in the past, where suddenly a new technique arises or some sort of market event happens, and we can change the handbook very, very quickly, which you can't do with regulation.
Yeah, indeed. I would add, though, that the handbook is not exhaustive. So it's not, from what A to Z, how to do a transaction. And the way I try and present it is it operates within four walls. And on the one side, there's stuff which is compulsory. It's mandatory in law. Now, obviously, the handbook is not going to debate what's required by law. It's required by law. End of story. You're not going to repeat that. At the other end of the spectrum, obviously, there's things which are prohibited by law, and obviously those things there's nothing to talk about either, because those practices shouldn't be happening anyway. And then what you have, up and down in a sense, is that you have material which is water under the bridge, long established. And if you're going to, the handbook is not about teaching people how to suck eggs. If something is relatively basic and established, that belongs to academic teaching. It's not going to be picked up in the handbook. And at the other end of the spectrum, we also have things which are new and incoming, new developing practices. And in this sense, the handbook is normative, not usually formative, in that it recognizes existing good practice to give it that formal recognition. But it doesn't always say, right, guys, there's many ways we could do this going forward. Let's freeze one right from the go. No, we allow innovation to develop. And so in that sense, the handbook doesn't cover that either. And then within the residual space, usually we pick up on those things where there have been particular, let's say, certain frictions in market practice within syndicates, and therefore it's been thought worth the effort of the underwriting community to actually spend time and effort, because obviously people in our committees are taking time off their transactional work that they do for their employers to actually try and work on these market practices.
Yeah, thanks, Ruari. And also, I'll just make one other point, which I think is very relevant in Hong Kong, is that this guidance, these recommendations apply to international transactions in the bond markets, which are often very widespread geographically. So you'll have syndicates in different jurisdictions. You'll have the issuer and investors in many different jurisdictions sometimes. And because of the international nature of the ICMA Primary Market Handbook, it allows for sort of consistent practices in a lot of the details of debt primary markets and bond distribution, which can prevent fragmentation in terms of different practices that might be conflicting with each other in different jurisdictions.
Indeed. I mean, I would just add that the handbook, the aim is to promote market flexibility. And so we are not saying, there has to be only one way of executing transactions. I mentioned earlier that for recommendations and so on, the idea is that they apply unless you tell the banks, or the syndicate at the beginning of the transaction, actually, by the way, no, this particular bit we're going to do differently. And in that sense, you do have occasionally domestic style transactions that come into the international markets. But in that context, it's made very clear to the syndicate, and actually ultimately to the market itself, that this transaction is to be executed on a, e.g., Spanish domestic basis. And people know what's going to be involved. So that might, for example, involve entirely Spanish law documentation, certain other characteristics, but it all flows in one go. So you don't have to keep on saying, by the way, this ICMA recommendation doesn't apply, this ICMA recommendation doesn't apply, this ICMA recommendation doesn't apply, because it's all part and parcel of the fact that you're actually bringing a Spanish domestic transaction into the international markets, which does happen occasionally.
Okay, great. So we've talked a bit about the purpose, the way it's put together. Let's talk about some of the substantive aspects of it. So what does you mentioned that it's not exhaustive. What kinds of topics does the Primary Market Handbook focus on? What kind of topics does it not focus as much on? And what aspects of syndication are covered by our recommendations? So
I'll just give you a few examples. So in terms of organizing syndicate banks, you could talk about the mechanics of how the fee sharing amongst the banks is organized, on what timeline, when do they have to put in their expenses by, and so on. In terms of the intra-syndicate transparency, we've got this concept of an initial syndicate communication. So that's the initial, normally the invitation itself to join a syndicate can be actually informal and oral, but you tend to follow up quite quickly with an initial syndicate communication, which goes to the syndicate desk and gives some recaps some basics information. So at least the syndicate is clear, yes, that is the syndicate official who was orally invited is clear, yes, that is indeed what I was expecting to receive. And thereafter, we have a more formal even confirmation to managers, which is something that other staff within the bank can more widely focus on to start preparing their systems for the new transaction. So that's just one example in terms of the transparency aspect. I mentioned earlier, in terms of explaining new and existing market practices, the new global note concept developed by the ICSDs. But also one example that we've, for example, put into the handbook was about negative interest. There's been a lot of focus given, prevailing rates recently about negative interest and negative coupons, and some people wanting to actually specifically floor coupons at zero to prevent, a cash flow payment from investors. And we had to produce a note just to remind people that actually it's intrinsic in a bond that you cannot have negative cash flow, at least under English law, which is one of the more prevailing governing laws that's used, because a bond is intrinsically a one-way contractual obligation. A bond is a promise by the borrower. It is not a promise by an investor, and therefore an investor cannot be compelled to pay negative coupon. So it was just one of those things we put out there to try and ensure that terms and conditions of bonds, only include provisions that are actually required. In terms of the practical application of regulation, I mentioned selling restrictions already. We have, for example, relating to stabilization, which is the idea, as I mentioned, regarding the aftermarket stability of the bond. I mentioned earlier that investors don't want to turn up to the concert to see that the ticket is cheaper on the door than it was at the box office. And regulation specifically allows banks in various jurisdictions to undertake certain transactions to keep the price of the bond above a certain level, basically the execution level. And in that context, that requires a certain amount of paperwork. And so in the ICMA handbook, we've put in some template forms that people can use for stabilization reporting. So again, that's a practical application of regulation because that reporting is required. And lastly, standardizing documents and wording. Again, I mentioned the idea of selling restrictions, which, okay, is an application of law, but there are other examples which are not an application of law. So, for example, we've got a standard ICMA actual day count fraction that obviously is a concept, but we've actually got the legal wording for use in terms and conditions of bonds that's included in the handbook.
Okay, great. So these are the kinds of provisions, or I would say the kind of recommendations that are used on just a daily basis in deals in the market without too much fuss or too much fanfare. But there are certain topics that are discussed in our committees, especially recently and in Asia, that are very relevant to the current dynamics in the market and also to potential regulation. So in particular, we've responded recently to the SFC consultation on book building and placing in the ECM and DCM markets. And a few of the topics that have been debated for years, I would say, in our committees are absolutely front and center in this potential regulation. Let's focus on a couple of those. And Ruari, if you could tell us a little bit about how they're reflected, or perhaps not as much reflected, in ICMA's official guidance. So let's start with investor transparency and book disclosure.
Yeah, no, absolutely. Book status is something, and disclosure of book status is a relatively recent phenomenon. Historically, and purists today even would still say that investors should be making their investment decisions on the basis of the fundamentals of the transaction, i.e., is the spread that's being offered in terms of price, is that an interesting spread for me relative to other similar credits in terms of credit risk, as mentioned by Lee earlier. those are the fundamentals. Should I be investing in a transaction simply on the technicals because it happens to be popular, with my neighbors, and that my neighbor wants to buy one, therefore I want to buy one too? Is that, should that be a basis for an investment decision? Now, I think that usually investors are focused still on the fundamentals, but there's been an incidental focus on the technicals. Perhaps it could be because of, mark to market and things of that nature. But the point is that, especially with the aftermath of the financial crisis, I think that, one got into a habit of doing a bit more book status disclosure. That doesn't always happen. You don't have to disclose order book status. I mean, obviously, once you start telling investors about order book status, that you're telling them about order book status. But if you don't start at all, it's not required as such. But if you are going to do disclosure of order book status, there is a couple of concepts that we picked up in the handbook. One is that the whole syndicate has to, or certainly the active book runners who are involved in that element, need to be in consensus as to what it is you're disclosing. Order book information is not always perfect information. There's lots of debate, sometimes even in the press, about things like order inflation and things of that nature. And so the syndicates are focusing on whether they feel comfortable with doing giving an order book update, because the underlying law requires any information that's given to be clear, fair, and not misleading. And so in that sense, if you feel that, let's say, that the order book information that you have with you internally is quote unquote too messy, then actually you may decide that the best thing to do is not to do an order book update at all. And that's therefore why you require, ICMA simply says you need to have that prior consensus before you can do any disclosure.
Yeah, and to be clear, Ruari, I mean, our consensus view of our members, certainly that we've expressed to the SFC, is that book disclosure should not be mandatory. But if it is mandatory, it should be clear. It should be not misleading. It should be accurate to the extent.
Yeah, I mean, certainly it's the case that I say the law today requires it to be, not misleading.
Well, of course, right, which is just complying with law.
So I suppose if I think if people start doing order book updates, order book disclosure, then perhaps one can imagine regulations around the dynamics around that if relevant. But I think the core message remains that it shouldn't be mandatory. I mean, one can imagine, particularly in volatile markets where a transaction doesn't kick off with immediate momentum. If you start making order book compulsory, the risk is that you basically have to emphasize the fact that you're not getting immediate momentum. And panic is one of those things that can happen in the market when the fundamentals are fine. I mean, do we really feel that transaction technicals should override the fundamentals? From a systemic risk perspective, I mean, I find that very concerning. We've been in a bull market for, well, you can argue how long for, but decades in the plural, potentially. If that shifts, when that shifts, do we want to have a regulatory system in place that's entirely premised on there being a bull market?
Yeah, I mean, book updates have been very popular for that very long period of time of having this bull market run. There are times in the past where markets are not performing well and deals don't perform well, and you might see very quickly the book updates disappear altogether because disclosing a non-performing deal is not very positive for the success of the transaction.
That's right. Okay, and Ruari, we have had a few discussions as well with our committees and actually released some guidance in terms of the nature of book updates, in particular with respect to internal orders or orders that are connected somehow with the syndicates themselves. Could you maybe go into a bit more detail about these?
Yes, no, absolutely. In the handbook, or rather, we've had discussions, for quite a while amongst the banks that obviously, different orders within the book, even, once you're clear that, from an internal perspective, you have your clarity on what the order book is, there are different kinds of orders, and some orders may be of less relevance to investors than other orders. So if, for example, a borrower would like a minimum transaction size, and therefore the banks are going to put in, will cover up the difference, then okay, the banks will cover up the difference, but that's not necessarily reflective of market demand in that sense, and therefore one would need to be careful about not confusing people by including everything in one go. So what's been happening for a long time is that either internal non-arm's length internal demand has either been excluded from book updates or has been segregated in book updates. And that's something that we've actually put an item in the handbook that explains, a basis on which you can do that. And the reason is that some syndicate banks, rather than simply blandly segregating or blandly excluding, they would like to set out or explain to investors the basis on which they're doing it. And if they want to do that, then they can simply say, by the way, this book update is based on ICMA 5.13. And by doing that, and we've published 5.13 on the ICMA website, that means that people can cross-reference to the basis for that book update without having to read through, add an extra 25 lines onto the announcement, which obviously on Bloomberg screens and so on, people are busy. You want to try and keep that to a minimum.
Sure, and I'd like to emphasize that not all so-called syndicate orders, very roughly using that term, are not necessarily all created equal. So we are a bit more nuanced about how we think about internal orders and through our member syndicates as well. We definitely distinguish between, say, first of all, orders from syndicate members, asset management arms, or their treasury, asset liability management, their balance sheet management functions. These are generally perceived as arm's length orders, as long as they are protected by an information wall. So these would be treated like normal external investors, or at least that's how we would advocate. And this would be distinguished from orders from syndicate members' own trading desks or their own syndicate desk orders, which may be privy to private side information, which could have some effect on the pricing as well. That's not the same as selling to an arm's length investor. So out of all the discussions that we've had, this is actually quite important to our members, that we, the market and regulators are able to distinguish between the actual kind of external investor style orders that might happen to come from within the same group, and the true kind of prop orders that may be of a private side and of a closely connected nature.
Indeed, and if you are following a 5.13a and doing your book update, those internal orders, which are the arm's length internal orders, which are in that sense real demand, they would be included in the book update, albeit on a segregated basis. Whilst the I suppose the underwriting orders, if you can call that, or the solicitor trading orders, they would actually be excluded altogether.
That's right. And let me actually get back to the point you made earlier, Ruari, about account X orders. So these are basically, sorry, we didn't really define this at the beginning, but what we mean by account X orders are orders where obviously the identity of the investor is not known. And so one of the syndicate members will get an order, but not necessarily disclose the identity of that investor to the rest of the syndicate who is managing the overall pot. Now that obviously has some problems to it, one of which is potential duplication, of course, but also just lack of general transparency. It has been a feature of the market that has, I think, continued to live on, but I think now, especially in the context of the SFC consultation, the overall consensus of the market is that account X orders can and probably should be just prohibited outright. Ruari, maybe you could give us a bit more. Yes,
indeed. I mean, looking back to the history on this, as I said earlier, it's a bit like going back to the retention process to a certain extent. Now, a few investors, and we are talking a very tiny few, may really have a legitimate reason for wanting the privacy from the rest of the syndicate, and that may not necessarily impact then the overall concept of pot syndication. I say the purpose of pot syndication is to do make coherent allocation recommendations based on an overall view of the pot. If you have a view of 99% of the pot, actually, arguably, that's not a problem. The 1% that's missing. You've got a view of only 49% of the pot. It starts raising questions as to whether you're really actually getting the benefit of, more than starts raising the questions. You've probably got, you're way into problematic territory there. And so in that sense, as I say, very few investors really have that legitimate concern. And to a certain extent, arguably that might be more in the supra-sovereign area. And those kinds of transactions tend to be executed away from Asia in any case. They tend to be mainly executed in Europe in that sense. And so, but historically, we in ICMA have at least tried to, in the handbook, point to some mitigants for this respect. So one is that the issuer, at least the borrower, needs to be aware of the name, even if the rest of the syndicate is not. Now, you mentioned the duplication risk. That's something that disclosure to the borrower alone may not be sufficient, because the borrower does not know. The whole reason why they're hiring a syndicate is because they don't have the time to go into the minutiae of running an execution, a transaction execution. So they won't be running through the order book to actually look for potential duplication. So it's only a partial mitigant. Another one in the handbook is to try and explain what I've just mentioned now about how, if you have too many X orders in the book, it impacts the ability to allocate effectively. So that's something that to try and help banks explain this to borrowers, so that borrowers themselves, because ultimately a lot of these choices about transaction execution come down to the borrowers. If the borrowers, don't want to run a transaction on that basis, the banks work for the borrowers. So all we can do as banks is explain to the borrowers the implications of what they might want to do. So if they want lots of X orders, it's the borrower's transaction that's at risk. And again, some borrowers may care more than others about how the ticket, the concert ticket price is doing at the door of the concert venue. Some borrowers are more focused than others, and a lot depends on that. So in the end, yes, it's true that in Asia the conclusion has come around to, a prohibition might be the simplest way of addressing this, and that's why we've come out with in the consultation response.
That's right. And one more topic that you alluded to very briefly earlier, but is, I think, a problem in DCM deals and ECM since the dawn of time, which is inflated orders. How has ICMA discussed this, and what is our current stance on this on behalf of members?
No, absolutely. So order inflation is something that basically we've known whenever there's been oversubscription, which obviously in the bull market conditions that we've had has been significant, and particularly following the aftermath of the financial crisis. It's always been, people are talking how many times oversubscribed, are you? And that makes it very difficult, because if you've got 100 seats to sell in a concert and you've got 300 people who want to go to the concert, it causes problems. And in that context, I suppose some investors, there are various ways and reasons investors might inflate. One is simply they're trying to anticipate this oversubscription. There's 100 tickets, there's 300 people I suspect who are going to want to go. I want to go, I'm going to put in for 3 tickets, and therefore if they reduce me, proportionately, I'll still get my one ticket.
It's a bit of game theory. If everyone thinks that everyone is going to over order, then
indeed,
everyone would over. Yeah.
And that's something that obviously then has it has a escalating effect. It's a bit like a vicious circle, because people expect inflation, therefore, or expect oversubscription, therefore they inflate. That increases the oversubscription, and it starts the whole thing going again. And one of the aspects of syndicate art is to try and work through that. You have you try to have the best understanding you have of the investor base. You try and understand, for example, the assets under management. What kind of orders they put in those kinds of transactions in prior transactions, and try and get a feel of what's out of sync, what seems incoherent. Is the order come in at the last minute following a price change or a book update? As in you've had a book update showing oversubscription. They thought, oh, it's popular, therefore I'm trying to anticipate that. In some cases, it could simply be investor internal logistics that, transactions, as mentioned by Lee, can work on a very, very fast, intraday execution. That's the nature of the markets. And if the investor has not had a chance to check with its internal desks for individual portfolios how much they want, they estimate, what their demand might be, and they might then overestimate. So, those are a few reasons why investors might inflate. And the point is, when we're making allocation recommendations to borrowers, we try and see through that. And, if certain investors are, serial inflators, a discount factor will will be applied in trying to work through that process of preparing an allocation recommendation to the borrower. The system is not perfect, but broadly, I would say it works. I mean, transactions are successful in the aftermarket, and so we work with what we can on the bank side.
And ICMA's recommendation is, of course, and really, I suppose, the rules of the game are that syndicates cannot knowingly pass on inflated orders.
I mean, absolutely. If you merely think it might be inflated, you have to work with the order is the order. And you can possibly ask a few extra questions if you can. I mean, it depends on the level of transparency and bandwidth that you get from the investor base. We're working on fast execution transactions. You haven't got the time to literally call the investors in for a meeting and say right. What's actually behind here. You might not even have time for a phone call.
As Lee mentioned, I mean, these deals get done in a matter of hours, right?
Indeed, and you can have hundreds of line items of orders within one book. So but if an investor in a conversation putting an order in and actually says my order is for 20 million, but I really want 10, the banks will take 10, they won't take 20.
Right. Okay, one last question. We're running out of time a little bit, but one very important topic that's come up, particularly in the Asia-Pacific markets, maybe a little less so in other jurisdictions around the world, is on rebates. So this goes to the very fundamental question of investor fairness, how much the banks are receiving in compensation, how much the distributors are receiving as well. This is mentioned in a general context in the Primary Market Handbook. And Ruari, perhaps you could tell us about that. And Lee, if you want to give us a bit of a sense of ICMA's overall view on this, particularly after some very extensive debates around the SFC consultation and their proposed rules on rebates.
No, sure, Mushtaq. Rebates, I mean, basically the concept is that some people are getting bonds at a price that is less than the market price or the offer price for the bonds. Now, historically, that is something which has been recognized in the market as what we call a selling concession. And the idea is that certain people who are not underwriters in the syndicate, who do not have underwriting risk, i.e. the risk of retaining the bonds if they're not sold, can effectively take, or rather sell some bonds. They don't have to take responsibility for if they don't get sold, but they can say, listen, I'm selling X bonds. I'm selling 50 million of bonds for you. And so they will be able to effect that sale of 50 million. But they're not actually keeping their bonds. They're not actually investors. And so traditionally, the remuneration of this selling group was that they got a selling concession. And that was a relatively formal thing. And I think what's happened, and that's mainly doesn't happen in the markets anymore. It's more of a historic thing. But what's happened separately is that a similar concept has evolved where regarding, I think, high net worth retail investors, where private banks have effectively been not buying the bonds, to put into the portfolios and so on, but literally for on sale to high net worth, or doing the on sale to high net worth retail. And they had some parallels with the concept of selling group, though not exactly the same. And so whilst from the syndicate perspective, this has been made transparent in public announcements, in the prospectus and so on, it's still left disquiet in the community as to whether this should be happening or not. But the handbook itself recognizes what is, I say, now more of a legacy concept of selling concessions only, and that doesn't go into the specifics of the private bank rebates that have been more current in recent years in Asia particularly.
Yeah, I just think it's important to clarify that the practice that's now disappeared of selling group agent, they are a broker that's going and further expanding the investor base in the deal that the syndicate otherwise couldn't do. So they're being given good consideration for actually a task, which is finding further investors that are third parties. When you have a managed account, either a private banking or an asset management relationship, you're a fiduciary. The end investor is already your client. And I think the view is that if the fiduciary pockets the rebate without telling their underlying client, that's potentially a breach of their fiduciary obligations. That's not right. On the other hand, if they pass the rebate on, then you've got a situation where the end investor is not all getting the same price. And I think, you know, for market integrity, you want there to be one price for everybody. I think the point is, I guess where we've come out is that they can be paid so long as both they are not given to the end investor, but at the same time also are not breaching a fiduciary duty of the intermediary.
Which is a very fine line,
Doesn't leave much left over.
Yeah.
Okay. Well, thank you very much, Lee. And thank you also, Ruari. We really appreciate you sharing your expertise here. And we'd be delighted to hear from any market stakeholders, investors, issuers, intermediaries, service providers, official sector representatives, if you have any questions or comments about any of the topics we've covered or our primary market handbook. Thank you again. We wish you good health and an excellent summer. Goodbye.